All right, everyone, welcome in for another episode of the Entrepreneur Aligned podcast. I'm your host, as always, Jarrod Music. And today we're talking about something that has come up more and more frequently with clients of ours and also with people that we're meeting for the first time, and that is alternative investments, or alts for short. So alts are one of those things that, depending on previous experience and your own personal lens, alternatives mean significantly different things to different people. So when we're talking about alts, first we need to define what it actually is. So when you look up the definition, an alternative investment is one that doesn't fit in the traditional categories of equity, income, or cash. So essentially, it's more about what it isn't than what it is. So if we're thinking about equities, income, or cash, the definition of income is debt instruments. So debt, which is issued typically by another company to be able to fund growth, expansion, or operations, owned in the form of a bond or a note or a warrant or something like that, right? So equity meaning stock that's issued by a company. And then cash is pretty straightforward. Cash, money markets, short-term commercial paper, and other debt instruments, right? So essentially, if you are not one of those things, you are, by that very broad definition, an alternative investment. So that can include a litany of other asset classes. So when we're talking about alternatives as something to invest in, what we should really be calibrating our thinking is, okay, this isn't stocks, it isn't bonds, it isn't cash, right? Now we can start to drill down into some of those different types of alternatives. And real estate can absolutely be an alternative. So when we think about real estate, there's a number of different ways to access it. You can be an LP, a limited partner who just allocates money to a particular real estate strategy or investment. The general partners are the ones who take the legal liability and the risk of executing the deal. And there's a split out in terms of who earns what as a portion of that deal. That's a fairly standard structure that you'll see in real estate investing. That could also be as part of a very, very, very big deal where you're a very, very small partner, or you could be a partner in a very small deal. So something where, perhaps it's a single home that somebody's looking to fix and flip. You can invest in that directly. You can lend them money. That's an alternative investment, right? So when we're thinking about real estate being an alternative asset class, it certainly is. Now, when the water can get a little bit muddy is when you look at publicly traded REITs, real estate investment trusts. That's a standard structure that allows for much larger real estate investments to solicit and raise money from a larger pool of investors. REITs have really been around for quite a while. They kind of gained prominence in the 80s and 90s, and you've probably owned one, whether you realize it or not, as part of a 401k or an IRA, or just a broad asset allocation that you may have done with one of the online investment platforms. So you may have already done real estate investment trust investing. Now they're traded on exchanges, meaning the wrapper there, the thing that holds the asset, is actually traded a lot more like a stock. It may have a ticker that you can actually look up through your investment website. So don't get too hung up on the wrapper that it's in. The asset itself is considered an alternative. When we think about commodities or currency, that again may be something that you've invested in on purpose or by accident in one of those other investment vehicles. So they are alternatives. Commodities can be things like corn or wheat or pork bellies as a future. It can be oil. It can be natural gas. Essentially, a commodity is something which is produced in volume and generally consumed either as an end product or as an input into other things. The same thing with currency. If you wanted to invest in, what you think the future of the Swiss franc and the US dollar is going to look like, there are future currency swaps that you could use. I'm not going to get into, the particulars on those investments, but I'm just trying to, again, give us a little bit more definition around what an alternative investment or an alt is. So commodities, currency, futures, exchanges, swaps, those are different vehicles that you can use to invest there. Now, one thing that I think most of us would consider to be an alternative investment are precious metals. So gold, silver, platinum, things that you can hold in your hand that are supposed to retain value over time, right? So the idea behind a lot of those that different people use them for is, okay, well, what if we have massive inflation? Perhaps those precious metals, because they have intrinsic value, meaning they are limited, they cost effort and energy to go mine and process and get into those pretty gold bars and coins, they're going to retain value, right? That's the idea behind those being an inflation hedge. We haven't seen that work super well during this current inflationary period over the last few years, but in general, they do have an intrinsic value, so they're supposed to hold that value over time. You may also be able to exchange them when other methods of exchange don't work very well, right? So if we had a shutdown in the banking system or something like that, well, you'd still have your gold. You could use that to, I guess, go to your neighbor's pumpkin patch and buy a pumpkin to eat, or a goat or something, right? Highly unlikely, but that's part of the idea behind owning those. But I think when we think about alternatives, their main feature is that they behave differently than the stocks, bonds, or cash, right? And so gold, silver, platinum certainly have that characteristic, meaning that if the stock market is up, your gold may or may not be up. Your silver may or may not be up, et cetera, et cetera, et cetera. But collectibles, some coins and some bars are considered to be, more collectible. They may be rare. You may have very old, Greek or Roman gold coins, something like that, where their intrinsic value is now based on their age and who they were made by. It's not necessarily the metal itself. But you can also consider artwork to be something that is an alternative investment. So there are actually different platforms now that allow you to invest fractionally in portfolios of art or in individual pieces of art, and be, again, one of those limited partner investors, in the belief that, XYZ sculpture is going to be worth a lot more, in the future. So we want to be able to own a share of that, right? Lots of different platforms have come online to make that stuff more accessible. You don't necessarily have to be a decamillionaire where you own the art individually and pay for the security to keep it safe. You can now own a piece of a portfolio. So that is an alternative investment. Now, when we start getting into some of these next areas, this is what I think typically when we talk to clients or prospective clients for the first time, what they're thinking of with alternative investments and what they have questions on. So this is private equity, private debt, venture capital, different pieces of syndication, meaning people who are putting investors together for specific objectives, for specific projects, specific types of investments. So you'll notice what I said a few times there was private. And that's where we tend to get into the realm of, okay, these are alternative investments in the way people are thinking of because they're private. They're restricted in access. In some cases, you may not even be able to buy in if you're not an accredited investor or a qualified purchaser, meaning you meet different criteria in terms of investment expertise, income, or assets inside your family that the Securities and Exchange Commission has said, okay, you should be able to understand the risks of this private, highly illiquid investment. We're going to make sure that only people who properly understand the risks are able to invest here. Now, you can agree or disagree that that's the correct approach, because it does gate a lot of individuals and families out of being able to do some of these investments when they may have the expertise, but they don't have the financial resources to be able to invest in them. So again, not the point of this brief commentary. We're just talking definitionally about what alternative investments are, and I'm going to get into why you actually might want to use them, how you might want to use them. But when we're thinking about private instruments, private debt, private equity, venture capital, those are usually gated and restricted to certain investors. They may call for your capital all at once up front. If you say, yep, I want to put $100,000 into it, they may take it up front, or they may say, that's fantastic. We're going to let you know when we're willing to accept your capital, right? When we actually have the building under contract or have the companies in the portfolio ready to receive investment dollars or something like that. Those are what are called capital calls, meaning they're going to ask you for your money at some point in the future. You may be signing subscription documents, meaning, yep, I understand the terms and conditions of what I'm committing myself to. I'm okay with that. And then you may be getting tax documents that are showing up as 1099s, as K1s, a variety of different things. It may be difficult for the issuer or the underwriter or the provider to be able to calculate their taxes every year. So you may be getting your tax documents in late April or August or September, and you may be filing tax return extensions based on the individual investments that you're investing in. So this is what most people think of when they're really thinking about alternative investments. So hopefully what I've described prior to this gives you a little more context that yes, those are what most people would tend to think of, but it isn't limited to just those. Alternative investments or anything that are not stocks, bonds, or cash. So why would you even bother, right? Why would you take the time, deal with the hassle to be able to go in and invest in some of this stuff? Well, again, the expectation is that these things should perform differently than your stocks, bonds, or cash. Now, notice I didn't necessarily say better. Ideally, they're going to perform better over an extended time period. But when we start talking about alternatives, the dispersion or the range of return outcomes, even from similar types of investments, get much, much, much wider. So if you're investing in an index fund in stocks, let's say the S&P 500, you are getting the cap-weighted return of all 500 companies that find themselves in that index. And cap-weighted means whatever the value is of a company relative to the overall index. So the most valuable company in the S&P 500 right now, I believe, is still Microsoft, and it's about 7% of that index. Company number 500, I have no idea what it is, but it's about 0.01% of the index, right? So you're going to get portfolio level returns, meaning if the economy generally does well, if companies are generally profitable, that's going to show up in the returns of the S&P 500. Now, let's say you want to do a private real estate investment that invests in, let's just call it a portfolio of auto dealerships, right? That's something you could, I'm sure, find a provider who's putting that package together. You can probably find multiple providers who are putting that together. Now, the range of returns between someone who does that really well and someone who doesn't do that quite as well can be significant, meaning one of those could be up 20% year over year and the other one could be down 20% year over year. If you're investing in a market index, you don't have that type of risk. You're going, sometimes the market's up, sometimes it's down. But on average, I think over the last 50 years, the S&P 500 has returned about 10% a year, right? So you generally know what you're going to get. With that car dealership portfolio, you really don't know what you're going to get. That's why extensive due diligence is required. You need to look at, are the managers qualified to be doing this? Have they done it in the past? Where are they sourcing their money from? Is it just from investors like me? Are they going to raise debt on the property? When does that debt mature, right? Are they going to end up in a crunch where they may have a bridge loan that only extends for 12 to 18 months and they need to refinance the debt once they've raised money from equity investors? Well, what happens if they can't raise the equity money? What about the debt holder? Do they get to call for their note back? Is there a provision to extend it, et cetera, et cetera, et cetera? These are just a few of the things that you really want to be considering when you're looking at alternative investments. So you want them to perform differently. You want to understand what you're getting, and you want to do your due diligence on the manager side. So when we think about this from a portfolio perspective for clients, we're typically allocating a smaller portion of client portfolios to alternative investments. It could be 5 to 25% of total assets because they're not liquid every day. You can't just walk up to the fund provider and say, I'd like my money back, please. Can you value it and hand it to me? They're not valued all the time. They may offer liquidity on a quarterly basis or an annual basis, or they may not offer liquidity at all. It may be you'll get your money back in 7 to 9 years when the fund hits the end of its life cycle, if there's any money left at that point. So we want to be very careful that we're only allocating capital that isn't going to be called for by our clients in the time period in which the investment is still operating and doing what it's supposed to be doing. So that's why we typically don't do 100% in alternative investments, even if we were sure, which we're never sure, we think that the returns are going to be great, right? So when you're thinking about alternatives, that's one of the key considerations is when do they provide liquidity? When can you get access to your money? So it's doing something that's different than the rest of your portfolio, your stocks, bonds, and your cash. Another criteria for entrepreneurs is, are you going to be able to get something that is different than your stocks, bonds, and cash and your private business equity? So we talked about private equity as one of the types of alternatives. You may not want that as part of your alternatives portfolio if you already have 70, 80, 90% of your total net worth in the private equity of your business itself. So if you're going to be doing any types of alternatives, maybe you want private credit, private debt, some of those other pieces, private real estate that are just going to perform differently so that you don't have all of your returns coming from the same industries at the same times. That's why you want to look at alternatives. That's why you want to look at all of this different mishmash of asset classes and decide what are you trying to get out of it. So hopefully this gives you a good 15-minute primer on alternative investments, how to think about them, how they may or may not fit for you, and that, just to put it out there bluntly, may be part of the total outcome here is that you say, I don't want to own alts. I want to own my business. I want to have an investment portfolio with stocks, bonds, and cash that I can liquidate any day that I want or need that money. And that may be a great approach as an entrepreneur. That's part of our job over at Entrepreneur Aligned, is to make sure that we're mapping all of those future anticipated cash flow needs out, making sure that we're helping you understand what your appetite for risk and volatility is in things inside and outside of your business, and how to put all those pieces together. So we work with clients where we're managing their business equity and cash, and our job is all planning and coordination and tax planning and all of those different things, which is great. We have other clients where we're helping them with their private business equity, their stocks, bonds, cash, alternative investments, et cetera, et cetera, et cetera, and they're all working together. It depends on your unique and individual situation, and that's why we always recommend work with an advisor, work with your CPA, work with your tax attorney, work with somebody that you trust, ideally, yes, that is going to be able to help you understand what these risks look like, what all of your needs look like, and how to put all those pieces together. So hopefully this was helpful. Please feel free to head over to entrepreneuraligned.com. We have a written blog that accompanies this podcast, so feel free to head over there for a little bit more depth and insight, and reach out to us anytime. Reach out to me. Let me know if this is helpful and what podcast topics you'd like for our next iteration. Thanks so much for giving me some of your time. I'll be back with you again soon.